Welcome to this video guide on One Up on Wall Street, where we explore timeless investment strategies for the everyday investor, based on the principles of Peter Lynch, the legendary manager of the Magellan Fund. Did you know that everyday investors often hold a distinct edge over Wall Street professionals? While institutions are hampered by red tape and short-term pressure, you have the freedom, local knowledge, and patience to find great investments years before analysts catch on. Your daily life is a powerful tool for discovering investment ideas. By observing trends in your community, work, and shopping habits, like the Dunkin' Donuts principle of finding consistently busy stores, you can identify winning companies through simple observation. Successful investing requires a shift in mindset. Stop thinking like a speculator, betting on lottery tickets, and start acting like a business owner. Remember, every stock represents a piece of a real company, and its long-term success is tied to the business's fundamentals, not daily price swings. Before you buy, do your homework. Observation is just the beginning. Research the company to verify its story, ensure the product has a meaningful impact on sales, and perform a 2-minute drill to explain your simple investment thesis. In the long term, stock prices are tethered to one key metric: earnings. Ignore market noise and macroeconomic fears. Focus on finding companies that can sustain consistent earnings growth over time and buy them at reasonable valuations. To set realistic expectations, you must categorize your stocks. Peter Lynch identifies 6 categories, ranging from slow growers to turnaround candidates. Knowing which category your stock belongs to is crucial, as the rules for holding and selling differ significantly for each. Slow growers and stalwarts provide the foundation of a balanced portfolio. While slow growers offer reliable dividends from mature industries, stalwarts are large, stable companies that provide both some downside protection and steady capital appreciation. Fast growers represent the 10-bagger potential, stocks that could increase tenfold. These small, aggressive companies need room to expand and require a proven, profitable formula to succeed. However, be aware that they also carry high risk if their growth momentum slows. Cyclical companies have fortunes tied to the broader economy. Success here depends on precise timing. Buy when the industry is at its bleakest and earnings are down, then sell when the cycle hits its optimistic peak. Turnarounds involve companies that are down but not out. These offer high risk, but potentially spectacular rapid gains. When evaluating them, ensure the company has enough cash and manageable debt to survive the crisis. Asset plays involve finding hidden value, such as real estate or significant cash, that the market has overlooked. This strategy requires deep industry insight and the patience to wait for the market to finally recognize the company's true worth. Mastering valuation is essential. Use the P/E ratio to gauge the price relative to earnings, and the P/E-G ratio, which incorporates growth, to determine if a stock is a bargain or overvalued. Remember, never overpay for a stock, regardless of company quality. Always check a company's financial health by reviewing its debt, cash position, and inventory levels. Watch out for red flags like heavy bank debt, unfunded pension liabilities, or inventory growing faster than sales, as these can easily ruin your investment thesis. Finally, look for qualitative clues. Widespread insider buying is a strong bullish signal, and share buybacks can enhance value for remaining owners. Focus on boring companies with niche monopolies that keep competitors at bay, as these often stay under the radar. Now, let's address common traps. Avoiding hot stocks, those driven by hype rather than real earnings, is vital. When the hype fades, the fall is often brutal. Also, beware of diversification, where companies buy unrelated businesses instead of returning value to shareholders. Be cautious of companies touted as the next big success. These successors rarely match the original. Similarly, avoid whisper stocks, companies with a compelling story but no actual revenues or earnings to back it up. Stick to the facts, not the narrative. Mastering the art of holding is key to capturing a 10-bagger. Many investors make the mistake of selling winners too early after a small gain, while stubbornly holding on to losers. Lynch calls this cutting the flowers and watering the weeds. Remember, time is your friend. Most significant gains often emerge in the 3rd, 4th, or 5th year of holding a stock. Don't set arbitrary sell targets. Instead, let the company's fundamentals and growth story dictate when it's time to exit. The golden rule for selling is simple: sell when the original investment story is no longer true. Monitor your companies for categorical signals, such as market share loss for slow growers or P/E ratios that become extreme for stalwarts. Volatility is inevitable, so view market corrections as opportunities. Declines of 10% or more are routine. If you have the stomach to hold through the drops, you can even add more shares of great companies while they are on sale. To wrap up, patience, discipline, and observation build long-term wealth. Start your own journey today by practicing the 2-minute drill on the companies you interact with every single day. Happy investing!